All right. Let's see. We are live. All right. So we got all the stuff here. Okay. Socials connected. Just waiting on YouTube. Come on, YouTube. There we go. All right. All right. Let's get started. Hello, Smart Money 2 podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host. And today I'm joined with Doug Hagren. Hey, Doug.
Good morning, Kirk. Happy Monday, beginning of another great week for everyone.
Yeah, happy Monday. Happy Monday. Well, it was an eventful weekend, and I'll tell you, I have a love-hate relationship with this month. It's not always May. Sometimes it's April, but this year it's May, or half of April, where it's beautiful out and I can't enjoy it because I've got allergies, and it's New England. Pretty much everyone everyone I know has allergies, so it's struggling here a little bit. Even though it's raining and better, it's still struggling here. So it's usually about 4 weeks. It's miserable, and then after 4 weeks, just goes away, just like magic. So I'm looking forward to that. I think we're in about week 2. 2 more weeks to go, and then I'll be happy again and be able to enjoy the spring. Do you get allergies up there, Doug? Do you guys have problems up there?
We do. I think it's a reality everywhere that everywhere in the country. We don't have it as bad as the South does. I know the South, you get one of the things the South deals with. Thankfully, we don't get quite as much up here as cedar fever, which is a real thing. The cedar trees pollinate. You can actually literally see the clouds of pollen coming off of them on a windy day, and it makes people really, who are sensitive, really sick in the South. Even people that don't fight allergies can find that they're battling more headaches and just feel like everything's inflamed. So we thankfully we get a little bit more of a reprieve up here, but we're not completely out of the woods, literally.
Yeah. Well,
Pun intended.
Fortunately, that's not one of the areas that I have an issue with. I when I was younger went down to Florida for spring break, and I never had a problem there. I'd be dying with allergies up here. Go down there, it'd be perfectly fine. So, I don't know. Maybe it's just too much exposure to the same stuff. But I'll be happy when it's over. That's for sure. All right. Well, moving on. We've got it's raining here. It's supposed to rain for the next week, so maybe that's my reprieve. All it means is when it stops raining, it'll just the pollen dust will just puff up and be everywhere. But anyway, let's dive right in. Lot to talk about here. Lots happened over the weekend. Big news: Warren Buffett officially retired. So all those of you who are Buffett watchers, he is officially retired, and he says that he will not go sit in a nursing home somewhere. He is going to still be active with the company, but he will not retain final decisions. He's passing that along to his second in command, what was the guy's name? Abel?
Greg Abel.
Greg Abel, yeah. He's passed that along to Greg Abel, who I think has probably been, from what I understand it, making a lot of decisions prior to this anyway. So it wasn't. But it is interesting because his partner, Charlie Munger, died, I think it was about a year ago, and now Buffett's retiring. I think he probably should have retired 25 years ago, but who am I to say? Don't want to knock on the old guy, but I've said this many times in the show. I think he kind of lost his way right after 2000. His big thing was buying capital efficient businesses, and ever since 2000, he's been buying capital inefficient businesses, railroads, just a lot of companies that require capital to operate, which is not his model. He very much deviated from his model. Now that being said, his stock has performed very well. Especially as of recently, when other things have not, his Berkshire Hathaway performed well. So, anyway, my point being is that even the best of hypothetical, or depending on what you think of him, potentially the best investor of all time can lose their way. So, just keep that in mind. Nobody's infallible, but also we can all make mistakes, and that's something that I think is really important, especially as an investor or trader, is keep in mind we can always make mistakes. We always do make mistakes, and we can always learn from them. So I know there's been a lot of critique about that strategy in the last 25 years, but he's still a great investor and he has a lot of cash. What do you think about this, Doug?
Well, I think of a couple things. First of all, I wanted to kind of make a note that, and again, a lot of his returns, people have dissected that. Did he, most of his returns from early in his career to later, how has he performed, going back to what you just said about what he's investing in. But I did see something, and I don't have it in front of me, so I'm going to quote it slightly differently, but I believe his return since 1969-ish or wherever he kind of started investing is, I believe it was 2.5 million% return versus the S&P 500, which I believe was something like 68,000% return. Either one would have been a fairly fantastic place to put your money, but I think it's hard to argue when people make the statement that he's the greatest investor. Over the course of the time that he has been active, his performance is incredible. And I remember 2008, and we go through this periodically, where people will question whether or not the markets have moved past him. If we go back to 2008, and prior to that, again, there was a lot of talk because he wasn't, actually, I'll go back to the 90s. A lot of talk, he wasn't in tech, he's missed it, he's too old, he's outdated, he doesn't know what he's doing anymore. And then the tech bubble imploded. And guess what? I don't know when the comment came out about you don't know who's swimming naked until the tide rolls out. But he has found in multiple occasions, every time he's been questioned, that the tide rolls out, and guess who's got a nice fat bathing suit on? He does. Right?
Well, I have a question for you, Doug. This has always been puzzling me about Warren. Why he's like best friends with Bill Gates, yet he never invested in Microsoft. And I look at Microsoft as a great investment. Ever since I think it was 2014, it was like really dirt cheap. And Buffett never touched it. All these years, he knows Gates, like it's his best buddy. He probably has inside information. He never touched the stock. Why? I don't get that.
It's a great question, and you're right, because what is Warren? One thing Warren kind of established that, especially in this day of private equity, you don't see at all. And I know a handful of companies that have gotten exceptionally large by following a similar model of when you see a company that you believe in and you invest and buy into that company, you are not only investing and buying into the company, its model, its product, its service, whatever it is, but you're also investing in the leadership. Right? So when he would buy Geico or Dairy Queen or Berkshire, Burlington Northern, and there may be some exceptions to this. I haven't done the study, but he would basically buy them and say, whatever you're doing is great, keep it up. And he would be, at least to the public view, fairly hands off, not telling them what to do. Now, behind the scenes, I'm sure there's deep conversations that are happening. This is in contrast to, say, someone like Bezos, who would say that, hey, I'm buying this great company because of the great leadership, but then he was notorious for getting in and tinkering with it, and now I'm going to change all this stuff, even though he said he doesn't.
What about
the fact that he knows Bill Gates so well, right? And the fact that it is, and what does he love? He loves companies that are essential infrastructure companies. Like, you think of it like Coca-Cola. I wouldn't call it infrastructure, but it's an iconic American business. It is something that people consistently go back and purchase. And it's a conglomerate of a lot of different type companies out there that, touch any number of different consumer goods. Heinz Kraft, same thing, right? It's not going away. Their products are embedded on, in retail grocery shelves. Burlington Northern, he saw, look, we're going to continue to ship things across the country. It's almost like an annuity. Like, those businesses continue. Dairy Queen, it never gets hot. Dairy Queen sells, right? The Dilly Bar has always been served at the, at the Berkshire Hathaway annual meeting. He loves stuff. Well, let's go back to your question on Microsoft. Microsoft is embedded in everything that we do. This is not some flash tech, and he said, I don't understand technology. I'm not going to invest in it. I don't invest in things I don't understand. He stayed out of the airline industry for decades and said finally he invested and he regretted it because it's such a volatile business. But Microsoft has consistently been a cash cow, and it has consistently been integrated. Even when we moved to cloud, they were ahead of the curve on cloud, and they were positioned with, Office 365 well in advance of releasing that. You look at today's day and age when Google came and now people, schools are using Chromebooks, and Chromebooks really replaced Apple. Apple was the technology in schools. Microsoft never was. You go to the business world, we're still predominantly running Microsoft as a backend. And so again, there's a company that is integrated in US, if not global, positioning. He knows the CEO, he knows how it's run, and yet it is not someplace that he has decided to put his money. And maybe Kirk, the question is that Microsoft is almost too big, because if you think about companies he's bought, he's generally gone in and they've amassed a majority ownership of. They become a Berkshire Hathaway company, and it's possible that one of the reasons he hasn't, this is pure speculation, hasn't invested in Microsoft is there's no way that Berkshire Hathaway can make Microsoft a Berkshire Hathaway company. It's just beyond that.
I think, it's an interesting idea, Doug. I think, yes, but he doesn't own all of Coca-Cola. He doesn't own all of any of those other companies he's bought years ago. I do agree that I think where it comes from, at least from my understanding, is the Warren Buffett's biggest problem is he's too big. He said this many times. He said if he had $100 million, he'd be able to get like 30% returns a year. Or I think he said 50 actually. So I think he could probably do okay if he had smaller funds to manage. But because he's gotten so big, he has to find bigger investments. The one question I always was curious about is why not invest in private equity? If he's going to own a company forever, invest in private equity. But he hasn't done that. Probably in part because of what we're talking about is they're not big enough.
And he believes in actually letting those companies run. Private equity.
Well, I mean, yeah, but he's made some private investments, but I think in large part I think the big issue is he's trying to find investments that are big enough. I mean, he did invest in Apple, or I would argue Greg Abel invested in Apple. He just went along for the ride. Apple over Microsoft, I wouldn't have made that bet. I mean, maybe at the time, but the other thing too is, remember, is Warren Buffett's also about valuation. It's not just good companies; it's good companies at the right price. And I think part of the challenge is Microsoft's been expensive since 2015. It was really cheap in 2014. It was like, it's like cheap enough for a deep value investor to be like, wow, that's a great bargain. Now it's been pricey for a long time. So, so is Apple, but you could make that argument. Apple went from a growth stock to a value stock. There have been times where it said, hey, it might be cheap enough. So I don't know, but either way, they made a good amount of money in Apple. And so I think, but that was the new guard making that decision.
Well, you know what? Actually, and we move on from it, but a couple things I just pulled up here. He actually found he's actually been fairly open. He said it would be a mistake for me to buy Microsoft, not because I don't think it's a great company, but because of my friendship with Bill Gates, because he was on the board. Gates was on Microsoft's board till 2020. Buffett sat on Berkshire's board with Gates. Buffett, I guess, has commented he was feared regulators might question if he had non-public material information. It was a minefield he wanted to stay away from. And so I think that might have led a lot into it. You're right. The size and strategy, he preferably likes companies with predictable cash flows and moat-like durability. And while Microsoft has that, the valuation of massive size may have reduced his view of their upside. And in the end, he said, look, if I buy Microsoft and Bill is on board and people think I had an unfair informational advantage, it gets messy. I like to avoid the appearance of impropriety. That if you look at the other companies that Berkshire has purchased, that wasn't probably any that really wouldn't have bubbled up to the surface. And so I think that maybe you're right. Gates is his friend, and that might be the problem. They're too close.
Yeah, I mean, there's ways around that. I mean, I think superficially, I think that's a smart move, but
Mhm.
there are ways around that, right?
Agreed.
There are absolutely great ways around that. You could call out in advance, I'm going to buy this over the next month. I mean, there's things you could do which publicize what you're doing, so it no longer becomes private information.
Yeah.
But I get
I
it.
mean,
I mean,
I mean,
the reality is either you have inside information, or if you don't.
yeah.
If you have it, you can't invest in it. If you don't have it, you can invest in it. People want to claim stuff, they're going to claim it. I mean, people claim things all the time. People claim that there's lizards running around in human skin. So people say things all the time. It's whether you believe them, I don't know.
Only
But
on X, Kirk. Yeah.
no, that's
But I will
everywhere,
say
Doug.
this. Berkshire does own a lot of Microsoft. You said there's ways around it. He does own a lot of Microsoft indirectly. I mean, he has, he owns financials. He owns indices like SPY and VOO proxies that include Microsoft. So in a way, I would say that you're what you just said there makes sense. He has Microsoft in a lot of exposure. He's just not directly owning the shares.
Yeah, I was referencing the movie They Live, a great 90s movie with Roddy Piper.
Oh, a classic, of
A
course.
classic. Oh man. Well, all right. Well, let's dive into other news. So that's Warren Buffett's officially retired. Here's other news.
Well, Trump is Pope. We've got the conclaves over.
Oh, did he? I didn't. Yeah, it's so hard to tell what's news and what's not. I don't know what he posted versus what's on the internet. But it was a funny thing, funny video. Um, so another thing that happened last week, we had a negative GDP print, and people are freaking out, but not really. And let me see if I can share this. There we go. So we have negative GDP print, and people are freaking out because 2 of those in a row equals a recession. I think we saw back in 2022, first quarter, second quarter. Second quarter was not quite negative, but a lot of people thought we had technically hit a recession with 2, but Biden said, no, it's not. So things are adjusted up, and then we weren't. Go figure. But we had our first negative GDP print, and it was in large part because of the net exports. So I want to kind of talk this through. A lot of people don't understand the way GDP is calculated, and frankly, I don't think it really much matters. I think there are probably better ways to calculate it, but the way they calculate it is imports and exports. So there's net exports, and so if you look at this, you'll notice net exports is very negative. Well, so basically, here's what happened. A lot of people knew, well, pretty much everybody knew, unless you're sleeping in a cave, that Trump was going to start with tariffs. And you had a few months to prepare. And so what basically happened was, if you were running a business and you're half intelligent, you went and you bought a bunch of inventory well before the tariffs. So you avoided the tariffs. And so when you buy a bunch of goods and you don't sell them, then that's built up inventory. Built up inventory leads to what people would argue is, oh, that's a recession because people aren't buying. Well, that's not what happened. It wasn't because people weren't buying. It's because they front loaded inventories. So, if there were no tariffs and no Trump, we were just in like a lukewarm market where everything's just operating, and all of a sudden inventories start building up and people aren't buying them, that's a sign of a coming recession, right? Or an existing recession. But when you have people front loading inventory, it's like you're buying the next 2 quarters today. Well, that kind of skews the normal ratios and leads to, wow, look at all that inventory buildup. Well, it was deliberate and it was planned, and we all know why. So I would argue that, yes, technically it's a negative GDP print, but it's a little bit skewed for that reason. It's happened before. It'll happen again, whatever. But you can see here in the yellow where the inventories are built up. So, you could also note that government spending has dropped. So negative government spending. Okay. That's a big component, right? And that's going to get smaller or more negative as they continue to cut government spending. So that's a contributing factor at the same time. You'll also note that total consumer spending is about half of what it was in the prior quarters, which is a contributing factor. Okay, well, that's something, right? If consumer spending is dropping by half, that's something. Okay, that's one I could look at and say, okay, that's an indicator right there. And pretty much all the rest, housing's not all that big, but business investment, apparently, when Trump got elected, it told business owners, hey, we feel positive about the economy. So they started to spend. As you notice, pretty much in the last year, there was not much. Last year and a half, there was not as much business spending, business investment. I'm sorry, business investment. So a lot of that had to do with the fact that people just had no visibility on what was going to happen. And we're in a service business, so it didn't impact us. But anyone who had to invest a lot in their business, that was a tough time. I can't tell you how many times I've heard business owners saying, I don't know what's going to happen next with this administration, with Joe Biden. So anyway, I just wanted to kind of share that. I think it's important to note. A lot of people don't pay attention to GDP, but it's every once in a while, it's good to just kind of talk that through. I also want to point out one more thing here before we send it back to Doug, which is shipping. Now, Doug talked about this last week. He had some great stats, but when you look at shipping, it's about, what is it, about 24 days, 30 days, where
it's about 30. It's about 21 days to get to the West Coast. And then from there, you're going to feel it and take another week or so to get to the East Coast.
Okay. So about 30 days to get goods from China. Now, if the trade tariffs are going into place and people stop ordering, that's 30 days. We call it 30 days. And we're about halfway there. So, if you look at how many people are ordering containers from China, very few. So some people ordered in advance of tariffs, and hopefully they have their stuff in time and they'll be fine. But anyone else who didn't, they're going to be in real trouble. Also, there's a lot of companies, like Walmart or Target or like, big retailers who, especially Walmart's infamous for this, where they have squeezed the supply chain so much that there's not a lot of room for error. I remember hearing stories about how they were trying to squeeze the supply chain so much that they would actually assemble products on the container ship from the time it was going from China over here, rather than pay and extend the timeline and all that, which I thought was interesting. I don't know if that's true, but I thought it was an interesting story, an interesting way to squeeze the supply chain. Point being is some companies are really tight and they can't afford a hiccup. And this is a big hiccup. So the question is do they have enough inventory to last at least 30 days? Because if people haven't been ordering them for 30 days, it's been 2 weeks. So we'll see. I don't think this trade war is going away in the next 2 weeks. So let's say, do they have enough goods for 30 days? Well, if not, then it's going to be like, it's going to be like Cuba or communist Russia, where there's nothing on the shelves and you go to buy stuff. I don't know. I don't know how that's going to work. But I know that I've been hearing a lot about it, which means that maybe it's not as big a deal as people say, because people always over exaggerate, and companies aren't stupid. They know what's going on, so they find ways to compensate. So we'll see what happens. I'm a little skeptical that it's going to have a big impact and we'll have empty shelves, but I do think there's going to be an impact one way, shape, or form. And I don't think all companies are able to survive this, because not all companies have a big enough cash hoard to purchase well in advance for like a quarter to more than they need. So I just wanted to share that. I know I've been hearing a lot about it. I'm sure other people have too. What else, Doug? What else are you seeing here? I got a lot more stories to tell. But
yeah, well, I'll come back to a couple of things, and I'm going to tie this back to something we were talking about 2-3 years ago. Is this inventory potential crunch? Again, whether or not this occurs or not, this is the catalyst for something you and I were talking about called the bullwhip effect. And as a matter of fact, this again, for those who've been listening to the show for a while, this was coined by Procter and Gamble years ago, as they were trying. And it was funny because the topic was diapers, but they were trying to figure out like what is going to be the consumer demand for certain products, 1 quarter, 2 quarters plus out. And the goal of it was to try to make sure that they had the right amount of inventory to meet that demand, but not so much that they were sitting on a massive supply of inventory. When that gets out of equilibrium, like we saw in COVID, that creates a scenario in which you fall behind in your ability to produce inventory. That creates a bullwhip effect, spike in demand now for a limited, because if you produce too much, you risk your prices plummeting. And if you produce too little, you risk your prices spiking. The problem with either one of those is you drive your customers to other directions, right? And again, that's probably one of the if you listen to Trump, that's his goal, right? We want to drive those consumers to other areas. For him, it's nationality, right? So I want to drive them away from Chinese products to American products. I'm not going to name any specific names right now, but we're already starting to see that. If you were to scrub the S&P 500 right now, you can start to see some stocks that have actually weathered the storm a little bit greater than others right now in this market volatility, because of the public or institutional perception that they are going to be better positioned under this new potential normal. Who knows if this is here to stay, right? So there are companies whose stocks have actually blown up recently in this because they're already established with more onshore production capabilities than other companies out there that have been more reliant on offshore shipping, for either their entire supply chain, or like when we talk about the airlines and talk about an American company like Boeing. I've got a chart that we can show another time. I won't pull it up right now, but it talks about, okay, Boeing might be an American made plane, but all of its parts are coming from different parts of the world. Going back to Warren Buffett, and you ask kind of like the position, he's still sitting on a massive supply of cash, so why? Because he sees this disruption potentially, or, that is yet to play itself out in terms of deployment of opportunities. We talked about wanting to buy things on value. PEs, price to earnings are still astronomically high, right? Because, and look what's come out in the last week or two. We also started to get earnings reports. And for the most part, companies have blown those numbers out of the water, right? So all of a sudden, this fear that was, amassing, a month or so ago of what was going to look like, I think it was premature. Again, because if we're talking 31 days potentially for the impact of any shipping or supply chain issues to hit the East Coast, there was no way that was going to be priced into the earnings from the previous quarter, right? Because that's all earnings are looking at. What did it do? The earnings are such such an emotional shock to the markets. Yeah, they exceeded what we expected. Yeah, but that has nothing to do with going forward. Going forward, I wouldn't have been concerned with this earnings report. I'd be much more concerned with the next earning report, because now, coming back to my point, the bullwhip effect, if we do have a crunch in supply, if we are more reliant on China than we'd like to admit, at least in the administration's support for the time being, those goods can't come in. Well, now all of a sudden you have shot to the undersupply. So undersupply means more money vying for less goods. That drives up prices. That is an inflationary shock, right? At the same, and then of course what happens later is if we solve this and now they can produce and now they're trying to make up for that, and now you get an oversupply. Let's go back to COVID and hand sanitizer. It was super expensive, and then there were social media stories of people with garages full of hoarded hand sanitizer were going bankrupt because they'd leveraged everything to try to sell this higher pricing. That's bullwhip. Nobody knows, because we're being driven right now by an administration that can come out with new news any moment. It creates this I don't know what to do right now effect for companies. But for companies that are less reliant on those global production, they're going to be sitting better no matter what happens in the current, in the near term outlook, than those companies that are trying to figure out what's going to happen with our supply chain. If you're heavily reliant on China right now, there's going to be some pain. Because even if we have a short-term issue with this and you're now going to have to wait longer for your product, how does the bullwhip effect also come into play? Well, if I'm a consumer and I need this product, I'm not going to wait another month for you to get it in if somebody else has it now.
That's true. That's true, Doug. Yeah, consumers are very picky, and if you always shop at Walmart and you have to shop at some other store like Sam's Club for a month, you might do it, but that might not change behavior. But it might if Sam's decides to woo you and do things in a better way. It's possible. All right, let's get into some other stuff because there'll be plenty of news out that on that in the next quarter. One thing I wanted to share is I saw this the other day and I thought it was really interesting. I'm not really sure if this is a good indicator or not, but it's called the Starbucks indicator. So they're basically measuring same store. I can't speak this morning. It's Monday. Same store sales.
SSS. That's a little tough.
Sally sells seashells. All right, so
seashells what? Anyway, continue.
So I mean, I don't know if this is one of those chart crimes or not, but if you look, basically 2008 same store sales declined and it had a recession. In 2020 they declined, recession, and they're declining. So you naturally think there's a recession. I don't know if that means there's a recession or not. Maybe this is a chart crime. If it went back, another, I don't know when Starbucks really became a thing, but if you went back another 10, 20 years, we'll see. So I think it's potentially a chart crime, but it's an interesting metric to look at. It does make sense. It certainly falls in the non-essential category, getting a $20 cup of Starbucks coffee. If they were looking at bags of rice or chicken, I'd say, all right, but Starbucks is a little bit more of a luxury than anything else. So I don't know if that works or not. Go ahead, Doug.
I'm going to call it. I'm going to call it a chart crime, at least in one regard. Okay, well, but I'm also going to go back to the bullwhip effect, right? So, okay, 2020, we saw a huge turn negative, right? Well, I mean, stores were frozen. Nobody could go in. You couldn't. I mean, I can't remember if Starbucks was considered essential or not. It was the food industry, which tended to remain somewhat. But obviously, supply chains from where coffee's coming from, would have created a crunch there, so they would have less to sell. Now we had the coffee, but going into 2021, 2022, how come, same store sales went super positive? Was it because coffee prices went off the charts and they were able to charge more? What caused the boom in 2022 and that decline that we're seeing now that they're calling a recession? I love where they put the arrow. Look, we're negative now. It must be a sign. The trend of that negativity started in 2021. I mean, that with the first drop, slight pop, but if you're following a trend line, that arrow is starting way too late. And to me, that's a chart crime because you can look at the 2020 drop and it was out of nowhere. You can kind of look at the 2008, although look at 2006, it was already dipping a little bit. I mean, this recent decline, they're loving to show in this chart that it is, Stansberry's saying it's negative after, negative, and they're showing the arrow from the point it became negative. But the start of that trend line was well before that.
Yeah, I would agree with that. And I think the 2020, 2022 blips were anomalous because if same store sales decline 40%, naturally when people come back, it's going to spike in the other direction because this is a percentage change from 1 year ago. So we see this in some other charts too. And I always ignore the big spikes because it's just math that's kind of messing with you.
But even that decline, if we take that out, started in 2023. That was well before we were talking recession, well before any tariffs. They're not, but they love to. They're not showing that on the arrow. They want to start that once it came to zero. So to me, that's a chart crime.
Yeah, no, totally agree with you on that. All right, one other thing I wanted to mention because this has been in the news relatively recently, which is fast food. Actually, let me show this chart first. So I think we showed this a little bit last week. So here's the chain restaurant price increases for the last 5 years. IHOP 82%. Everything else is like 45 to 22. And sorry, I had to sneeze.
Allergies.
Yeah, allergies really really rough with all the rain. All right, so here's one that shows 3 of those: McDonald's, Taco Bell, Chick-fil-A, and these are specific items on the menu. Now, I point this out. I don't eat at any of these, but I point these out because I think it's interesting. Prior to COVID, French fries at McDonald's, 179. Now it's 419. McChicken 129. I don't know how chicken is less expensive than French fries, but now 389. Maybe
It says something about our
chicken parts. Yeah. Big Mac was basically $4. Now it's $7.50. So point being is there's a huge rise in some of these. McChicken's up 200%. Fries are up 134%. Cheeseburgers up 215%. That's a huge hike, right? 141% across these 5 items on average. Now, I point this out. They're not the only ones. Taco Bell, 57% across 5 items, 81% for Chick-fil-A for 5 items. So I point out this chart because if you look at the CPI, which is supposedly supposed to measure inflation across a large number of goods, I think it was like 21% over a 5-year period. 21, right? It didn't feel like 21. I can't remember a single item that I bought during that period that was only up 21%. Now, I'd have to go back in the calculations, but I know with about 80% certainty that, only because I heard it from somebody else, I didn't do it myself, that the government numbers are manipulated. Okay. I know people that are in the government numbers and they say that they're manipulated, but you got to take everything with a grain of salt. So, but it's pretty obvious from COVID when the CPI is 20%, 21%, and we're seeing these items of fast food, which is not known for its quality. So you're getting the cheapest stuff. 141% price increase, 57 and 80%. Now, those numbers actually seem more accurate to me because I know what we paid for food before COVID, and I know what we're paying now. We're well over 100% increase in what we're paying. Now, it's hard to note because I've got boys that are now teenagers and they're growing, so part of that. But let's say it's not. But I'm also saying it's over 100%. So let's say it's 80%. Let's take the items from Chick-fil-A and say that's the norm. That seems a little bit more accurate. So how did CPI only 21 and this is 80? Don't know. We'll see. Maybe someday. I don't think Trump had it on his campaign promises to disclose all the true government numbers. I'm pretty sure he won't because it's probably not a priority. But I would love to see at some point that government numbers actually become accurate. That'll never happen, but it'd be nice if they did. But I just wanted to point that out because I saw it and I was like, this feels more normal. So there's an indicator that I use for investing, for the markets, and for real life, and it's called the how do I feel about this indicator? and it's not numerical, it's not mathematical, it's more of a, I guess you call it a bullshit detector, right? It's like if you're looking at something, and can you call bullshit? If you're looking at something and somebody's trying to explain something, and immediately your thought is really. You're telling me it's this? Really? Like, if that's what's going on in your head, where you're in your mind, you're like, that doesn't make any sense. It's probably BS. And I hate to call this out, but it's true in so many regards. And this is one of them. The CPI is 21%. Really? What? Name one good that was only up 21% in 5 years. Really? So when I look at stuff like this, I say, okay, this feels more normal. This feels more like what I experienced over that period of time. Now, I don't know. I mean, maybe the government numbers are all screwed up because of one thing that they never share and, some magic secret sauce. But I don't think that's the case. I think someone put their finger on the scale. And in this case, this seems more accurate. Now, I don't know what the actual number is. So this is why I don't really like this about the investing world. The investing world looks at a number and they say, oh my God, this is the true number. We have to go change our whole portfolio around because this number came out and it says X. I think that's nonsense. That's when you're acting like a zombie. That's when you're not thinking, you're not paying attention. You're just saying, well, this number, it says X, so it means Y. If you put any thought to it and you realize that there's something rotten in was it rotten in Denmark? Is that the phrase? I may have made the location wrong, but anyway. But the point is if something is so obviously wrong, it probably is, and you need to check your assumptions. What are the assumptions going in? And this is an obvious case of that. So I don't know what the real number is of the CPI. I just know it's not 21%. And it's probably closer to 70 to 110 in that range. Like I said, I don't know what the number is because I'm not in the weeds in the math, but I know directionally it's a heck of a lot higher than what they disclosed. So anyway, I wanted to share this just because it's after numbers that kind of prove the point that we'd been talking about all along, that the CPI is wrong. And I think this is, I don't want to say it's proof positive because it's really not, but it's an indication that things are incorrect. So where do you want to head, Doug? We got a lot more to cover. Where do you want to go?
I'm going to touch on this really quickly. Is over the last month, I think just talking about, I want to get into real estate really quickly, just some updates on that, because I know that's certainly something that's always on people's mind. But I also wanted to kind of look at what's going on just with the market recently, and the impact of what's happened over, say, the last month. Sorry, I'm pulling some things up because the one thing that I think is always a risk is investing off of, and I've talked about this before, fixed income is mathematical, stocks are emotional. And I think one of the biggest things, are we going to jump into, do you want to jump into housing first? We can do that. I was going to talk about the markets, but you've got this up. So let's talk about housing before we get that. So, but since you put this up, I'll let you address this one and then I'll come back with some more stuff on the real estate. You're on mute, and you look great though, Kurt.
Thanks, Doug. Thanks. I appreciate that. That's all that matters. Doesn't matter what I say as long as I look good.
For those of you that were listening,
here's what I meant to say. So anyway, so these are headlines that I pulled. Doesn't matter where they're from, but they're just headlines, and that's what's important. Is this what people are talking about? So, or at least that's what the media is pushing down your throat. So Zillow is basically forecasting home values to drop in every large U.S. metro city over the next year. Now, I'm not sure that I follow Zillow for my financial advice, but it is interesting to note because they do have a lot of data and they do have insights. So, okay, we'll see. I'm not sure I believe all major U.S. metro cities, but directionally, okay, I believe that. I think real estate is, from what I've seen, that it is starting to decline in a lot of major metro areas. I have seen that. I don't know if it's all of them, but certainly in a lot of them, which is indicative of the sentiment of what's going on. It says it's already in 11 of 50 populous areas, most in 19 months, which doesn't really mean anything to me. And over 40% of mortgage refi applications are being denied, the highest rejection rate in at least 12 years. Well, that's interesting. That's very interesting. And I'm not surprised because everyone's stretching to buy a home they can't afford. I know because we're actually looking to buy a home now and we're just disgusted by it all. So while we want to buy a home, we're certainly not in a rush, especially knowing that at some point real estate is going to come off its highs. Maybe not in Boston, which is unfortunate, but that's the one thing I think Zillow is wrong. I think Boston's gonna not drop. I think it might stay the same just because Boston's a unique area. It's very insulated. It's very diverse economically. It's probably one of the most diverse economic cities in the country. It's got a lot of government money. It's got a lot of research money. It's got a lot of education money.
There's very little land left too. I mean, everything's just crammed. Yeah. So, I mean,
yeah, there's no, I mean, it's not like Texas where you got open land. Everything is just, you're just building on top of something else, making better use of old stuff. But generally speaking, I mean, there's a lot of building going on, but a lot of lab space in Cambridge. I mean, there were whole parts of Cambridge growing up that were just like, it was just like a wasteland, no buildings, just rubble, just empty blocks. and biotech industry saw that, or real estate industry saw that and said, all right, we're going to build a bunch of lab space. Lab space does very well. So anyway, so we want to just note that, because I think real estate, we've been talking about this for a while. And we've been curious why it's not dropping, but from what we're seeing, who knows? Maybe that'll be the case. Go ahead, Doug.
So a couple things. And this is a little bit of an article crime, but there was an article that came out by.
It's a new one.
What was that, Kirk?
So that's a new one, an article crime.
Yes,
I like
an
it.
Article crime.
I like it.
So there is an article, and unfortunately, I've only got a snapshot of the front page of it. But a starter home now costs $1 million in half the states in the U.S., a report reveals. Okay, so I'm sure this article crime is clearly coming from a chart crime. My counter to that is, you're telling me that a starter home now costs $1 million anywhere in half those states? There's your crime, right? No. The article should have been written. A starter home now costs $1 million in half the major cities in half the states. I would buy that. Okay,
I wouldn't buy that.
But more likely to buy that, Kirk. But still, but if you're talking even some of the even like, let's take Massachusetts for example, right? A starter home in Boston area might cost over $1 million.
No,
San Fran might cost.
I'm telling you,
I know. I realize you're denying that. I'm just using extreme, of these major cities. But you're going to tell me that a starter home in Western Massachusetts is also going to cost $1 million? This to me is absolutely ridiculous. All the different ways that you cut it. So no, I agree with you completely. Kirk was saying, well, I was talking, there's no way it doesn't even cost $1 million in Boston, right?
Yeah, Boston's one of the most expensive areas. Absolutely not. That's a BS statement, but I'm sure it gets headlines and clicks.
It absolutely headlines and clicks. It's one of the worst article headlines that I've actually seen in a while, because even if you're in one of those states, even in California, where might be looking at an area like starter home in this area, the Valley. Okay, but there are other areas in Eastern California. As you get close to Nevada, it's not going to cost you $1 million. So this is just absolutely egregious. But the one thing I think that is, you touched on this, and we've been saying this forever, and I will say this until I'm blue in the face. And no matter what happens in the economy, and no matter what happens that people are communicating on, the worst advice you're ever going to get on the market is from people who are biased and tied to that industry. So people that are pundits for real estate are always going to tell you all the great reasons real estate never goes down. I have known people who've gone bankrupt multiple times in real estate. Go back to Dave Ramsey, who loves real estate. One of the reasons he started his entire course on finance was because, guess what? He went bankrupt in real estate, right? They called all of his properties. And so, for years we heard people, realtors and real estate pundits and all that, just like the market's never going to go back down. And they would talk about how none of the data was like 2008. Of course it wasn't at the time. But the thing is, and this doesn't matter who you are and how smart you are, the inability to ever assess that history repeats itself is an endemic problem of human psychology. Okay. So what were we saying, year, 2, 3 years ago? Real estate has nothing to do with whether or not people want to have a home. Real estate has nothing to do with whether or not there's enough houses. Okay. They can always build more apartments. They can build more houses. Real estate is strictly tied to the availability of capital. And that's tied to the banks. That's tied to credit. That's tied to pricing. That's tied to interest rates. And once interest rates go up, that immediately makes the monthly payment of real estate go up. And if you tie both again, 2 years ago, we were talking about, real estate prices were super high, but interest rates were still low. So we were talking, the affordability on a monthly basis at the time seemed much, much more absorbable by the public. And banks, and this is a reminder to people, that a mortgage is not a house loan. I know they call it a house loan. They call it a real estate loan. It has been marketed that way. You need to go get a home loan. There's no such thing as a home loan. Okay, mark my words. There is no such thing as a home loan. A home loan is a bank package marketing to you of a personal income loan that is merely backed for the bank's protection by the lien on real estate. But if it was truly a home loan, Kirk, you could go out there and you could, and anybody who is out of work, who is a business owner that doesn't necessarily have a W-2 wage because, but they have great cash flow, they'll be the first to tell you, yeah, the bank won't give me a loan. Why? Because banks are merely tying that loan not to the real estate, but to your income. And there's only one income the banks understand, and that's W-2. And I'll go beyond that and say they won't even tie it to that unless they're backed by another entity. They're the most conservative and scared entity on the planet. If you go back to COVID, banks weren't giving PPP loans until the government pretty much said, don't worry, we'll absolve you. If we go back to real estate now, they won't give a home loan, a personal income loan backed by real estate, unless FHA says, don't worry, we'll absolve you. And as FHA is pulling back because they're getting more concerned, banks are going to pull back too. But now you go back to affordability. It's all based on income ratio. And if the price of the house is higher, and therefore the interest rate's also higher, what we've run into, and this is again why all the pundits said real estate's never going to drop. It was, and we knew it was going to. The instant affordability became an issue. And you have three things: prices are too high in homes, interest rates driven that up too. So now the payments have become too high on a percentage of cash flow basis. But now what did we just see in the last couple of weeks? They're going to start collecting on student loans again. Car payments went up because cars went through the roof after COVID. So people took on much higher car payments. People are stretched. So what's happening now? Those pundits that said real estate could never come down, they just reported 44.4% of home sellers. And again, everybody needs a home. So home buyers are going to have all of this luxury to just charge whatever they want. Well, 44% of home buyers just gave concessions to buyers in March. Mind you, this is home buying season. This is the time it's supposed to be the best market for home buyers. This is near the highest on record. A percentage increased by 10 points since July 2024, and it has doubled since June of 2022. Now, this is still, I agree with Kirk, this is still very market driven. Certain markets are going to be much worse than others. Here in the Twin Cities, in places like Ohio, where I grew up, in Columbus, where Kirk lives, I think you're still seeing areas where home buyers are getting above ask. But in Seattle, 71.3% of sellers gave concessions. That's the highest share amongst 24 major cities. Okay. So you're going to start seeing, you're starting to see existing home sales are scraping multi-decade lows. They've shown no meaningful signs of recovery. This is as a whole, again, market. It's going to be unlike a 2008. I think this, again, we agree here, Kirk and I, that this is going to be very market driven. But, home buyer low demand was this low in the 2007 to 2012 housing crash. That downturn produced a 25% decline in home prices. In fact, if you look at markets like Austin right now, they're already down over, in some areas over 25 to 30%. And I do have a picture showing the number of homes that are available, say in Dallas right now. That is I'm sorry, I flipped away from my screen, but we're looking at a massive number of open houses in Plano that are showing, you're talking dozens of homes that are having open houses, all of that competing for the same dollars. But the problem, and what Kirk said, and we showed this data last week and he repeated it, is that unfortunately it doesn't matter unless you have the cash. And even those that have the cash, the challenge that they're running into is, or that have the equity, is a lot of people are sitting on trillions of dollars of equity, and it's extremely illiquid. And they can't release that equity to buy a new home unless they sell the home they have. And we're starting to see less and less patience about waiting on that. You're starting to see more people trying to sell those homes, but it's a domino effect. Okay? And so if you can't sell your home to release that equity, Well, now it's like, well, I want to go to a bank and get a loan. The banks are not only not allowing for refis because of the stretch of cash flow, interest rates, debt to income, but they are also not, not supplying as much overall in terms of, liquidity based on their own issues, concerns of the real estate market in general. So they're tightening what they require. They're not getting as much backing on on FHA. So again, this is something we're starting to see the turn. And my point of this is, remember this moment. Okay, if you're one, especially if you're one of those markets, remember this moment the next time anyone who's insular in an industry or spends their time writing about that industry, about, and who makes their living off of an industry, always question when they tell you it's not going to happen again. It always does.
Yeah. Well, let's wrap it up, Doug. In the interest of time here, there was a lot we didn't get to cover, but we'll cover it next week. Specifically,
some weeks get that way.
Yeah, we'll get there. I'm sure more will happen this week anyway. So go ahead, Doug, wrap it up.
One other thing that I just saw that came out this past week was that we have seen a massive drop in not only the number of people that have been applying to college, but we also saw a massive drop for the first time in the number that have been applying to medical school. We are seeing across the board, whether it's cost. I saw an article recently, Kirk, and I wish I had it up here, but we could talk more about this maybe next week. But it was something like 30 to 40% of people that took out student loans that went to college and now say that their degree was worthless, that they didn't get a return on investment, that they're not doing what their degree was, that they are not able to get a job that returned that investment. And it's not to say that college isn't a good investment, but it is to say that there is a belief out there that, and it is true that having a degree will produce a better overall potential income over your lifetime than not having a degree. But what's happening is that too many people don't go into this with enough knowledge about what kind of degrees have a return on investment. Schools have gotten more expensive. Everybody believes that, look, my kid's going to be the outlier on this, but the numbers are showing more and more regret for how much people are spending for the cost of that education and what they're getting out of it. And so if you're just going into this, again, emotionally, pick a great school, reputation, using ranking lists, using where your child just feels good, and a degree that, and you're not really doing the research on that degree and what the return on investment of that degree, and you're not thinking about what could this mean if things change, the amount of money you're spending, and the impact, the collateral damage to every other financial goal you have, then you risk being in a situation where you're going to look back someday going, I wish I had more money, and what happened to the money I spent? It is, you fail to plan is failing to have the outcome you desire. And I think that we're starting to see a little bit more focus on that, especially with cash flow being more of a concern, the job market, the economy. Now is the time to really understand what are the ways in which you can approach finding an extraordinary college for your child and return on investment, but also thinking about how you're going to pay for college differently. And if you just want to be a smart money family that knows what they're doing and funds college the right way, you need to get the information. Start by going to our website, mergentcollegeadvisors.com, MERGENT, mergentcollegeadvisors.com. So you can be one of those success stories in a world where we're starting to see less and less of them.
Yeah, thanks for coming on the show, Doug. We're going to wrap it up here. So that's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast and the podcast app if you're choosing. You can also check out the show at moneytreepodcast.com. On the website, you'll have access to the show notes, resources, and the archive shows. Also, check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a show rating and comment on the podcast app of your choice. Oh, and don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send him an email and express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller, or maybe just a licensed financial advisor. I'm one. But as I said earlier, I'm not selling anything, but I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do. So invest